I'm joined today by Michael Hanson, Senior Vice President of Research at Fisher Investments. Michael is among the incredible investors sharing insights at the Equities Investment Forum today. Welcome, Michael. It's great to have you with us.
Oh, it's a pleasure to be here. There's been so many great insights here so far.
Michael, can you explain Fisher Investments' top-down approach to global equity markets and how it came about?
Well, the how it came about part is the important part. Capital markets evolve, and through Fisher Investments' nearly 50-year history, we've evolved with that. In fact, Ken Fisher started the firm by being a small cap value manager. And he was a pioneer in that sense. He came up with the price to sales ratio, which is now something really of standard finance curriculum and taught everywhere. But over time, what he realized is that the advantages those created, those types of metrics, decayed. And as the firm developed and had more assets under management, there was more demand for global management. And it wasn't just all about the US. And as a result, Ken and myself and others embarked on a journey of really asking, how do the global capital markets work? And one of the insights we had is that bottom up, simply looking at the constituent stocks by itself simply isn't explanatory fully of how stocks perform year to year. In fact, what you should do first is think about, how does the system work? How does the full global system work? Because that is the thing that has the most power, and from it then things happen. So as the system goes, then you can say, well, which country might outperform in this particular outcome, or which sector or style, and then from there, stocks. This turned out to be a very potent combination. The idea that you should, from a macro perspective, understand the environment, and then from there use that to create the categories or select the categories you want. It's a basic insight, but it's really a truism that if you select the right category, then your odds of selecting stocks that outperform also goes up. It's just a tautology that the best categories have the most outperforming stocks, and that's really a truism. So we start from the top down now, and that's how we've developed to get to the constituents, the stock performance and analysts. And there we do traditional bottom-up analysis, and we want to know about all the fundamentals. And what we're trying to do is link up, how does the top down look, and how are these companies going to perform in that environment? How will they benefit from it? And one of the keys of that is to understand, does the management know how to execute in this environment? Do they see the environment the same way we do, such that they can go off and create the returns we think they're capable of given that environment? Now, one of the things that's really important about that is that when you look at top-down thematic ideas, these are not things that last for 1 month or 1 week. They tend to last for a year or maybe even 2 years. There's the big macro patterns of the capital markets, but especially equity markets, tend to have some legs to them. They last for years, not just days or months, and that we want to have these thematic ideas that in fact will play out over the course of 12 to 18 months. That's very important for us because we think more than about 18 months, the future is just too indeterminate, certainly out of our ability to see what may happen. But 12 to 18 months forward is also sufficient time to see a theme play itself out, regardless of any noise that may happen in between. And lastly, one of the great advantages of top-down investing is that we do have an eye towards the big macro stock movements, which is to say, we can be nimble during bear markets or certain other parts of corrections in bull markets. And that's always been a touchstone of what we do.
So you've touched on it a little, but why take a top-down approach? Aren't equity markets all about stock specifics, stocks research, and finding hidden gems?
There's many ways to do this business. But in my observation, and one of the great things I've learned is that I really view the capital markets, and especially stock markets, as something like a complex adaptive system. And what that means is that the system shows dynamics and it shows adaptivity. And you can only see that from the level of the top down. You can't quite see that from the level of constituency. I always like to give a peculiar example, which is that the stock market is a little bit like your DNA. At the lowest level, DNA is a molecule, and as it combines and separates, that's a molecular process. But the next level up is that DNA creates organs, and organs have their own, or organs and cells rather, they have their own rules and their own ways of operating, not necessarily implied by just molecular structure. Then you go on up to the body and the brain and so on, and you have different rules, different patterns there. Capital markets are just so. The big top-down themes have their own styles and patterns. The system has its own pattern. And as you go down through the layers, getting to the constituents, then other things matter at each level. What we're trying to do in top-down investing is to say, given that environment, how will the constituents adapt to the system and therefore either thrive or flourish or not? And Without that insight, it's impossible really to know how a company is going to perform in any 12 to 18-month period. There is, of course, the avenue of saying you can be a long-term investor and hold on for many, many years. But the future changes very quickly, and our outlooks about things change very quickly. What we really need to know is, how do companies adapt to the environment, and how do they flourish or not?
So, how has Fisher Investments been able to successfully implement a top down approach to equities investing for over 30 years while many others have failed? What do you think are the key ingredients to its success?
You have to apply yourself rigorously to the empiricism and adapt yourself to the environment. But in doing that, experience matters, subjectivity matters, the people involved matter. And at Fisher Investments, all of us on the investment policy committee have been with the firm at least 20 years or more. Our senior analysts in our research group, many of whom have been lifelong careers there, that matters a lot. The continuity of that, the depth of experience and knowledge really is important at certain key events. Because the reality is, and I'm more like a psychologist than anything else, it's what my background is, at key moments of markets, turning points, places where you have to make difficult decisions, that's more about your personality and your experience than it is any number you have in front of you. And so it's the combination of these things. And so through time, we've evolved, because the things that once worked will not work for always. They will get priced in. Those advantages that you once had will get recognized. Over time, you have to create new insights as the capital markets develop as well. Our job is to continue on in that process, to create unique insights, but to use our enormous depth of subjective experience to inform that. And those are at those key moments that what can matter the most. So often in top-down or macro research, as it's often referred to, people think of binary outcomes. We have all our bets on Fed interest rate outcomes, or where AI is going, or something like that. That's really not the case with Fisher Investments. Part of our difference as a macro manager, a top-down manager, is to say we have a broad array of themes. And those themes, in fact, do have their own set of covariances, and we monitor that appropriately. It's, in fact, part of our risk analysis is, how do the themes interact with each other broadly across the world? One of the ways you have longevity over the long haul is building things in like that, because, of course, we're not right every single time. No one is. But doing things appropriately and having a broad array of durable, good themes can really help you when things go well for you and when things go poorly for you from a diversification perspective. Certainly, it's contributed to our longevity.
How does sentiment drive equity markets? And why is it important for investors to understand its impact on performance outcomes?
I think of sentiment as sort of the binding component to how outperformance or underperformance happens. And, for us at Fisher, we have three key pillars that we look at. We look at the economics of the situation. We look at the politics of the situation. I think we do that more than many other managers do, because we believe political outcomes really influence the overall structural environment and who outperforms and doesn't. And then lastly, sentiment, which puts it all together. The way I like to describe it is, our job is to try to see the world as clearly as we can, and then determine how the rest of the world sees it. Most sentiment indicators are not very useful. They're coincident indicators at most, but most of the time they're lagging indicators. If you look at sentiment indicators, what will they say? Well, people aren't feeling good. Why? Well, because the market just dropped. Are people feeling good now? Yeah. Why? Well, because the market just went up. So most of these are coincident, and you want to be careful with them. What you really want to do is measure relative expectations. If we see the world as one way, but the rest of the world sees it as much more negative as we do, the gap in relative expectations ought to be the excess return that's available to us. And that works in both ways. For example, this year, with the United States, we had a forecast that the U.S. would take a step back in leadership and actually not be the leading category. Why? Not because it was a terrible place. It's pretty good in the U.S. for the most part, but because expectations are too high relative to reality.
And what about US exceptionalism? Is it enduring or contested, both or neither? What will drive outperformance in equities as we look forward into the investment horizon?
Well, certainly what drove equities is not going to be the thing that drives equities in the future. There'll be new things and different things. But in the case of U.S. exceptionalism, I would really encourage people not to use the term, not to think through the term at all. I mean, it's just a term. It doesn't really mean very much. The U.S. has had a great time of it in the last 10 years or so in equity markets and so on. But looking at the broader history, and even within the last 10 years, leadership rotates more than people think. And that's very important, not just in the equity environment, but for thinking through U.S. exceptionalism. The truth is, in the world, the entire world has come forward in the last decade and more. That's inclusive of places like frontier and emerging markets, and also other countries that have come online and become great contributors. U.S. is not the only place that you can find a good investment. Lastly, despite the fact that the U.S. has such great operating companies and has advantages in technology, and some would say in things like AI and so on, other countries do things very well. And over the long run, what you want to think about is not just one country being dominant forever, because that never happens and never will, but rather, over the long haul, leadership does rotate. And because of the dynamics of supply and demand, the real determinant of stock price over that long haul really is the equity supply and the demand. And over the long haul, you should expect most, especially in the developed world, stocks to have a somewhat similar return across the broad categories.
Thank you so much, Michael. We're going to need to leave it there and get back to the forum, but I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Equities Investment Forum.
It's my pleasure.